Now we're going to talk about a second measure, accounting rate of return, which is defined as the return earned on an investment using accounting-based measurement, in particular, accrual accounting. We're still on Hogarth's example, where they have purchased a machine for $23,000 and experience cost savings over the next 4 years. The accounting rate of return ignores the notion of cash flows. In essence, it's using the gains and losses or revenues and expenses and costs as accounted for via traditional accounting methods. So, very simply, the cash savings that would occur for this project would be summed up. The $10,000, $8,000, $6,000, and $5,000 amount to $29,000 of cash savings. Accrual accounting, very generically, would treat that as an average amount each year. So $29,000 divided by the 4 years is equal to $7,250 per year in terms of cash savings. The investment amount of $23,000 would be depreciated via accrual accounting over the useful life of the project. Again, 4 years worth of time. Assuming a simplified straight line depreciation method, the $23,000 would be parsed out equally over the 4 years as well. That means that each year the company would recognize $5,750 of depreciation expense for this investment. The $7,250 effect of cash savings on average each year, subtracting from that $5,750 worth of depreciation expense, and dividing that over the amount of the investment. The numerator here represents the return that we're getting on the investment, the difference between the average cash savings each year and the depreciation expense. And the denominator is the investment amount. This number comes out to be 6.52%. And this rate of return can be compared to various benchmarks. Let's talk about some of the advantages and disadvantages of using the accounting rate of return. One advantage is, like the payback period, it's quite simple. Another advantage is that it's accounting-based. It maps to the financial statement effects of capital investments and therefore is comparable to accounting-based required rates of return. So if accountants and managers are speaking the language of accounting already, then the accounting rate of return fits right in. A disadvantage, however, is that it does not focus on cash flows, and the feasibility of a project often comes down to whether the cash inflows exceed the cash outflows.